I'm Charlotte McLeod with the Investing News Network, and here today with me is Paul Sousa, Senior Vice President and Investment Advisor at Sightline Wealth Management. Thank you so much for joining me online today.
Thanks, Charlotte. It's nice to be here again, and Happy New Year.
Yeah, Happy New Year. We're now in 2022, and it's been a while since we had a chance to speak with one another. So a lot has happened, especially when it comes to inflation and the US Federal Reserve's approach to it. To start off, I want to get your take on what you think of the Fed's plans for tapering and eventually hiking interest rates.
Yeah, I think it's needed. I mean, the 2021, the markets had a very strong rebound, driven by nearly unprecedented amounts of fiscal stimulus. And I think the plan is by June, the bond buying and the stimulus should end. And I think estimates are about maybe three rate hikes before the end of the year. So it's January now. This is a very fluid situation, so things could change, but that's the general consensus right now. The thing too with the markets is the markets are highly correlated to the Fed balance sheet. So once that stops, you could see, say, the S&P 500, the Dow, et cetera, to probably fall in sympathy with the bond buying.
Okay, and you mentioned that it's fluid, right? And this is something that I've been hearing a lot from people. Like the Fed seems to be leaving itself room to speed up, slow down, make changes. What is your sense right now? Do you think that what they've outlined is doable, or do you think we will see some changes as we go forward?
Well, I think everyone believes, I think, controlling inflation is this simple task of, press a few buttons, pull a few levers, adjust interest rates, and then, magically, inflation is subdued or tamed. It's much harder than what that sounds like. There's the much respected Taylor rule, and that is you want to raise interest rates by 1.5 times as much as inflation. So inflation has risen, I don't know, from 2 to 6%. So you want to do, that's a 4% rise. There's a 6% rise in interest rates. Like that seems unfathomable today, but yet we know what happened in the 1980s. So you want to actually, it gets worse than that. You want to add a 2% for the baseline target for inflation, plus 1% for the long-term real interest rate. So we're looking at potentially 6.5%, right? Something like that. So the problem is, though, the 1980, we had debt to GDP was about 32%, and today it's over 130%. So, rising interest rates will make the debt a lot more expensive to service. So this is going to be very, very tricky to kind of thread that proverbial needle. And I don't think it can be done as easy. I think there'll be a lot of dislocations. It's very fluid. So it'll be interesting to see in 6 months or every quarter, see how this is transpiring.
Yeah, definitely. This is something that everybody's going to be watching closely in the next 6 months, the next year. I think that we can go back right now to something that you touched on in one of our previous conversations, which is the idea that fiat currencies always fail in the end. So when you look at the situation right now, do you see the US dollar in trouble?
I actually don't. If you probably heard, it's the best house in the worst neighborhood in terms of all the currencies. It's still the reserve currency of the world. In fact, its strength is one of the reasons why gold it's not been able to consistently stay above 1,800. There's also strong employment numbers out of the States, and the rise in popularity of cryptocurrencies as well is something that's sort of taken some of the demand away from gold. Actually, just touching back on a previous point on interest rates too, in terms of the debt, I think there's going to be, we've all talked about this, but this come to home to roost moment where, there's been a lot of debt being incurred. Debt can be fun. You earn, this much, you spend that much, and, that's a lot of fun. And, we're going to have to tighten in everyone's belts, and you're going to have to earn this much and spend this much. So it's something that we're going to have to cut spending, increase the tax base as well, create jobs, you know, possibly borrow more as well in order to still keep monetizing the debt, and increase taxes.
Okay, and you started to mention the gold price, and this is a topic that's, of course, very near and dear to our audience. So let's talk a little bit more about your expectations for gold in 2022. With all of these elements in mind that we've been speaking about, do you think we'll get the increase that many people wanted to see last year now in 2022?
I don't see it happening this year still. I think the dollar strength, um, and money going into the markets too. I mean, with the significant real interest, sorry, the low real interest rates is causing money to flow into a lot of markets. There is no alternative. And so we see a lot of money flowing into there. Um, I see the Fed policy being somewhat neutral for gold. So I could probably see it anywhere bouncing around from 1700 to maybe 1850 over the next year. So I don't think this is the real rise yet. I think the real rise will come during a massive loss of confidence, and it'll happen very, very quickly. And so I don't quite see it next year, but you know, we'll talk again, I'm sure.
Oh, sure we will. And when you say loss of confidence, can you elaborate more on what you mean by that?
Yeah, so if you remember how things felt back in March 2020 and sort of with that fear and that panic. So I think something like that, but in a different basis, amongst to do with currencies, to do with the balance sheets of various sovereign nations, defaults on bonds. There's going to be, it could be, with rising interest rates, something that's I think underappreciated is the amount of over-the-counter derivatives worldwide is astronomical. And I believe the figure is something like 85% of those are very sensitive to interest rate hikes. So if we do have rising interest rates, and that's kind of one of my theories is why I don't think rates will rise too high, just because of how sensitive the over-counter derivatives market is to rising rates. So if 85% are interest rate sensitive, that would cause just such a massive turbulence throughout the world. It'll be felt everywhere. And to me, that's my bet in terms of if you're going to see a significant rise in gold, it'll be something to do with some kind of derivatives meltdown. There's a great story. I don't know if I shared with you a while ago when Warren Buffett was buying, I believe it was General Re, it was an insurance reinsurance firm. There's a very small derivatives position that they had. And I think it could have been maybe half a billion, or maybe it's $1 billion. I have to check it again. And he wanted to buy the entire company except for that book, for that derivatives book. And they said, no, Warren, it's all or none deal. So he took it on, and it took him a few years to actually unwind a lot of those positions and cost him a lot of money. And that was a relatively small book. And so when you look at the amount worldwide, and I haven't looked at it in a bit, but 1.2 quadrillion, it just dwarfs the amount of national GDP. Um, so to talk about loss of confidence, I think that could set off a cascading set of events. And, that's not to be an alarmist. It's just, it is what it is. And so I don't see that next year, or sorry, in this coming year, but probably in future years, if interest rates still continue to rise. That's my bet for how things unwind.
Okay, so that's very helpful. Thank you for that.
Yeah.
So move in gold, not this year, most likely. When we look at headwinds for gold, one thing that I've heard come up a lot over the past year is just the strength in the US market. So I want to talk about that a little bit. Is that a bubble that you think will burst or deflate a little bit in 2022? What are your thoughts there?
In the US market, I see lower growth in 2021. And again, because there is no alternative, money is flowing into the markets because yields are so incredibly low. Um, I see movement into alternative asset classes too, as a pickup on yield as well. And but I don't see the markets correcting heavily. Um, but again, after June, when the tapering stops, if it stops in June, and rates begin to rise, then I think probably we could see some lower growth, but I don't see significant fall at this moment. But as John Maynard Keynes said, when facts change, my mind changes. So it's my answer now.
Okay, very good. Now, we talk about gold in the context of the US market a lot, just because it has such an influence on the price and movements there. But you are based in Canada, you're serving Canadian clients. So I thought it would be good to get your sense of what's going on in the Canadian economy, Canadian markets as we head into 2022, just for people who are over here.
Yeah, so I think employment in Canada is actually back to pre-pandemic levels, and so I see rates rising in Canada before they do in the US. And so I do see, in terms of our cyclical nature of our economy, in terms of some commodities, I think we'll do well as well. Energy and various commodities, food, agriculture. I still think, in terms of GDP growth, will probably be about maybe 30 to 40% less than what it was in 2021, but also still, but still positive. Um, the other thing too is to remember is last year, or anytime the last two times the Bank of Canada increased rates, they quickly brought them back down to 1%. So it's pretty fragile. And just because they do rise, it doesn't mean they'll stay there. So Bank of Canada is shown to be pretty, um, I guess, non-committal to their decision, and so they are reacting quickly. If they see things aren't working out well, then they quickly reverse course quickly. So I think that's the nature of things. Are still very fragile. I mean, in Ontario here, we're in the midst of another lockdown, and that's until the end of the month for now. There's talks that could actually occur for a few more months. So if that does continue, then we'll start to see that affected into, or that factored into, some of the economic data.
Okay, yeah, definitely. We continue to deal with all this uncertainty in many parts of the world. One thing, though, that has remained consistent, you've always told our audience that although we love to talk about the price of gold, wonder where it will go, the price doesn't really matter. It's generational wealth, it's a store of value. So as we're coming toward the end here, I want to ask if you think that more people are waking up to that point of view, or people starting to realize more that that is what gold is there for.
Yeah, I don't see it yet. Um, I am not seeing it. In fact, I mean, in terms of the people that I meet, and I think, first of all, investors who are in gold, we talked about anywhere from a 3 to maybe a 10% allocation. So just have that allocation and carry on with your lives. Like, worry about everything else. I do find, even with that allocation, gold and everything gold related, and dominates gold investors' thinking by at least 50% of their time. They're really focused on it. And I think it's human nature. This is just years and years of evolution, where people don't recognize a crisis until it's really upon them, and they have that just this inability to think, or maybe they just rationalize it away. It's like, it won't get so bad. And so there's something, I think, it's interesting. They'll buy various insurances for various aspects of their lives, but when it comes to looking at goals insurance for the portfolio, uh, they're really hesitant to hold this asset class and just sit on their hands and just actually not think about it, and not constantly looking at the return of it. So as I mentioned earlier, I think the real catalyst will be a serious loss of confidence. Someone wrote years and years ago, could have been Doug Casey, said confidence is like a pile of feathers in a hurricane. It can be gone in an instant. And so the over-counter derivatives is one such thing. There's many others. And so I think, when that occurs, investors, if they're not allocated, psychology will then play a big part of their allocation. They'll think, oh my God, it just rose 30%. I missed it. So they'll wait for a pullback. The pullback doesn't occur, right? And then it goes higher, and then they're waiting again. So all these psychological games are come into play. So I say just buy it now when it's relatively calm, 1750 or whatever it is, fair price. Don't worry about it. You're going to own this for a long time, and really start worrying about everything else and what's going on.
Yeah, it's always hard to, allocate your worries properly.
Yeah.
That's all I have for you today, unless there's any final points or words of advice that you would leave investors with as we head into what looks like it's going to be kind of another uncertain year.
Yeah. Well, I think what's dominating my thoughts is, we're going to have to pay for this debt due to COVID spending. And, interesting, I think yesterday there was a piece out, a trial balloon. There's always these trial balloons put out in terms of attacking the principal residence exemption. And so I don't know if you saw yesterday a surtax on homes in Canada worth over $1 million, anywhere from, I think, 0.2 to 0.4% or so, and rising. And so that's being put out there, and so there'll be more and more of that. So I think investors sort of have to grasp with that reality, and it'll be, who knows, maybe an increase in probate fees, and there could be a death tax, or maybe a wealth tax. Maybe the capital gains inclusion rate will increase. Maybe they will attack the principal residence exemption. So I think I think one thing's for certain is we're going to have to pay for this bill. We will, our children will, our grandchildren, and it's going to be painful at the same time. So look for ways to minimize your tax burden and to be strategic. Because I think what I'm shocked about most is how quickly things changed in the last almost 2 years now. A lot of theories I've come across and read, and thought, okay, I could see that plausible sometime down the road, but at the speed of which everything was implemented, it was quite breathtaking to see. And so I kind of sense that patience level of putting out trial balloons with various taxes. It used to be, let's put it out there, let's see what the reaction is. If everyone's opposed to it, then we'll pull it back and we'll try again another time. I have a feeling there'll be more of a blunt force this time going around. It'll just be, we're not asking you, we're basically saying this is happening and there's nothing you can do about it. So that's kind of maybe what investors, to maybe take their mind away, allocate to gold and focus on looking for solutions to, arguably save what's the biggest leak coming out of your personal wealth is taxes. So focus on that.
Okay, perfect. Well, thank you so much for coming on today. Always great to talk to you.
You're welcome. Thank you, Charlotte.
No problem. Once again, I'm Charlotte McLeod with the Investing is Network, and this is Paul Sousa with Sightline Wealth Management.